So, welcome everyone to this Market Thursday. Happy New Year to all of you. I hope we're going to have a better 2021 than 2020. Even though as a trader, as traders, the market was pretty interesting, very volatile. And we'll see if we carry on with market volatility into 2021. So as a full and quick disclaimer, those webinars are not investment advice. This is mainly for information and education. So please do your own research and don't follow me. That's not that don't follow me, but don't do exactly necessarily what you've been told. And finally, I know some people are always asking, Greg, can you give me some buys and some some longs and some shorts? I consider that my job is mainly to do education and helping you getting an investment process. If you are looking for buys and sells, you are probably looking at sales traders or people that are selling something different. So that doesn't mean that from time to time I give calls. I'll try as much as possible to give you some indication, but don't blame the messenger. Quickly, I would like to go through my background. So I started working in 2000 in Paris as a cash equity trader, working under 50 million euro. We had overall as a book. My book was smaller. In 2004, I joined Griffin Capital Management in London, where I worked for 4 years. I was running both a long-only book and a long-short book, and we had roughly 600 million euro plus under management on the western part and largely more in the eastern part. In 2009, I joined Infinity Capital Market as a prop trader, where I was running a prop book, absolute return mandate, no asset and returns constraints. So that was my life for 9 years. Then in 2014, I started to do mentoring, working for another company. I left them in 2017. We started my own mentoring program in 2018, and in 2019, last year, I launched a 4x4 video series, which is hopefully helping some of you that I can see today, having an investment process and being successful in managing their own money, or if you want to have access to the industry. So, as I told you last year, my situation is a bit changing this year in terms of having a book. So I might be a bit less available and doing a bit less of those webinars. What I try to do as well is to do shorter webinars, because I think when it's too long, we are in a world where people get bored after 30 minutes. But the format is going to be pretty much the same, with a bit, sometimes a bit less content. And if you want to have more content, you can contact me, or you can do the mentoring as well, which is a great thing. So as always, we're going to start with the situation across asset classes. The 4 asset classes mainly, looking at the recent performances. Then we're going to be jumping into the catalyst, earnings season, the central banks, and we're going to be finishing this week, because we are at the start of the month, the ISM manufacturing in the US and the world PMIs. We had some service PMIs this morning and yesterday evening. So that's what we're going to be covering today. So the market, in terms quickly, has been a bit, is in a transition phase as there is a new administration coming. I know that Twitter was on fire yesterday, on fire this morning. As a trader, as portfolio manager, we need to be careful, and there is always a lot of noise. And I remember when there was the war in Iraq and against Iraq from the US, I was still pretty new to the market. I was watching the video, watching the pictures, and I was like, oh, this is the end of the world. And actually the market rallied. So be careful on all this noise. I made a decision a long time ago to not have TV here. I think this is not necessarily a bad thing. Clearly, you need to, there is a lot of information, and that's very similar to when people start the webinar, the mentoring. They tell me, look, I have access to a lot of information, data, but I don't know how to do the filtering. I think for us as trader, what is really, really important is to filter the good information and the right information. So again, be careful. There's always going to be a lot of noise, and that's going to affect your portfolio management. So let's look at, instead of looking at the performances of assets since the start of the year, which is a bit meaningless, I wanted to look at the asset performances since the US election. And why? Because obviously we had a rotation in the market, and as well, it came almost a week before we had the news on the vaccine. And again, here the question is not to look at if there is a coincidence between the two. I'm not into these theories. I'm just very factual. So I put the Bitcoin. I started to put the Bitcoin when it was at 1,200, 12,000. So don't blame me. Since then, it had been rallying 200%. It's just that obviously all the assets have been doing pretty well since the election. This chart is a bit distorted again by the Bitcoin, which is up 160%. I think it's up another 5% today. So let's look at the next slide, which is less distorted by Bitcoin, going through all the asset classes. I think what is interesting from the first part on the left is you can see that the Russell 2000 is up 30%. So in terms of rotation, there has been rotation. Why? Because the past leaders, which were mainly IT, NASDAQ, are still doing okay, but they are not outperforming vastly the overall market. And on the contrary, small and mid caps, Russell 2000 have been on a tear. They were on a tier even yesterday, where at one point the Russell 2000 was up 5%. So there is rotation. There has been rotation. If you look across this blue color, it has been a risk-on market. Emerging market have been doing very well. If we look at the purple colors, which is the currencies, we know that the dollar has been weakening around 5% or more since the election, so that is quite significant. Gold has been pretty flattish, but actually moving quite a lot. And WTI went from 30 to 50. Now it's trading at 51 this morning. So pretty big move. It's based on risk on it, and as well the expectation that the economies will be restarting. So the difficulties that we might have these days is the headlines, especially if you are living in Europe or in the US on COVID, are not that great. And on the other hand, as investors, we need to be looking at 3 to 6 months down the line. And normally at that time, fingers crossed, the vaccine should help massively our economies and restart those ones. Next slide. You know my style. I like to be looking at the 11 sectors of the S&P, because for me, this is a great way of understanding where is the flow going, where is the appetite, and thinking about economic cycle. So energy, which was really struggling until September of 2020, recovered quite a lot. So I think if you look at the WTI chart that we'll be looking later, the sell-off in February 2020 started around the 54, 55. So we are getting close of closing this, not a gap, but the start of this sell-off. The financials have been doing very well. So that is something that if you've been following me, and not only following me, but if you look at the financials, what is important is the 2 and the 10 years, how the yield curve is doing. If there is a widening or steepening of the yield curve, flattening or steepening of the yield curve, there has been a steepening of the yield curve based on economies restarting, inflation that might be coming. On the other hand, as we can see here, utilities and real estate, which are massively leveraged, and when yields are going up, this is obviously negative for the sectors, have been the underdogs. Anything that has been a recovery, industrials, materials, cyclicals, meaning have been doing pretty well, a tight better than better than the market, not that much. And IT, again, so let's say NASDAQ, XLK, has been doing more or less like the market. So there is not a huge alpha generation. And that is something that we started to warn, if you remember correctly, at the start of September. Start of September, we had the first warning of a possible rotation from value, from growth into value, from at least less FANG and less techno, and that has been confirmed. Since then, the sector overall has been struggling versus the overall market. So again, that is something that I really like. I always almost force my mentees to do during the first sessions, building their infrastructure based on understanding those flows and what have been the winners. My conviction is clearly you can't be looking at what's going to happen next if you don't understand what has been happening recently in terms of risk appetite and risk flows. Next one is the same. So I wanted to look at the asset classes performances since the election. The first part, the bonds, is about, again, understanding how the 10 years, how the bonds have been behaving. We know that the bonds have been selling off because there is the risk as well, because of fiscal stimulus, because of monetary stimulus, that there's going to be a tons of bonds coming into the markets. To create and for the market to digest that much bond, yes, you do have the Fed, but it's not going to be enough. So investors may be asking, and they are asking, for a bit more yields. So that is interesting to see that since the election, we are 20 bips. So we are now at 1.05%, meaning we were 85 bips just before the election. And yesterday we had a big move. So yesterday we had a massive move across asset classes, and bonds were selling off. So TLT is now trading at 152.23 pre-market. And I think the 155 level, 154 level that we saw, that we checked before, is now pretty gone. So that's a tale of, what we need to be doing. That's something that I'll be covering more into details next week in the 2021 Outlook webinar, is, where dollar, where bonds, where inflation are going to be, or might be going into 2021. In terms of the volatility, the VIX, so for the newcomers, the VIX is the implied volatility for the next 30 days for the S&P 500. So this is a good benchmark to understand roughly the volatility. At least this is a good entry point. So we are now, at least yesterday, we were at 25%. I think now we are at 24% or roughly this. We had a spike, the spike just before the election, if you remember correctly. So there was a sell-off. We went to 37%. And we had a spike as well since the start of the year, because on Monday we had a sell-off of I think it was 2%, and it was almost more than 3% during the session. So the VIX, we're going to be looking at it as a trader. This is really the first thing that I'm looking at, which is the implied volatility. Where is the volatility? As a portfolio manager, I'll be looking at the VIX as well to see how much exposure I can build. Top winners, top losers, there are a lot of noise, so I don't want to be spending too much time. But what you can see as well, that the moves have been pretty insane. So if you look at the normal ATR, or let's say historical volatility on single names, it's much bigger than usual, and that is what has been characterizing this market for the last few months. The moves have been pretty insane. So if you are playing the odds, some kind of reversion to the mean as a strategy, these days you're really struggling. The reversion to the mean, when it's extending, and instead of having a 2 standard deviation move, you get a 3 or 4 standard deviation move. That can be extremely painful, because in between you're going to be reaching your stop loss, if you have a stop loss, and hopefully you have a stop loss. And if you don't have a stop loss, then it is time to adapt a stop loss. Catalyst, again, when we think about putting position, when we have position, we need to think roughly what's going to happen short term. Okay, so short term is going to be, let's say, 1 minute to the next month. Midterm, 3 to 6 months, and afterwards for longer term. So what we're going to have tomorrow, we're going to have the NFP. It's a lot of noise. It's a lagging indicator. People love it. Some retail traders love it. Be careful. It's mainly noise. But next week, we're going to have some Chinese number. I think it's going to be important to look at the M2 money supply, how much money they are putting into the system, the CPI, what is the inflation component telling us. In the UK, for those of you living in the UK, the GDP estimate. And then at the end of the week, we're going to have the industrial production and the University of Michigan. So this is the first part. This is for next week. But more importantly, we know that from next Friday, the earnings season is starting. So my benchmark, and for many market participants, you need to be looking at JP Morgan. JP Morgan is the really biggest company that is starting the season, so that will be next Friday. And then on Monday, actually Monday the 18th, the market is closed because of Martin Luther King. So it's going to be a long weekend. Be careful when you get a long weekend, because going into the Friday, the market's got a tendency to trade always a bit different. Then other catalyst that I'm looking into the short term, which is on the 21st, the ECB meeting, and on the 27th, the Fed meeting. Okay, as always, looking at when is the Fed coming, when is the Fed buying bonds, when is the ECB talking, and going into the next slide, which is very, very important. Last year I talked a lot about it, and probably too much, but still, which is the options. It took me time to realize over the years, being a cash equity trader first, that the market was more and more driven by options. And I can tell you that it's even more true these days. So most of the volume is driven by options. Most of the flows are going into options. So for us as portfolio manager, it is really important to know when are the options expiring. So you're going to have several expiries now: Monday, Wednesdays, Fridays. You're going to have weekly, you're going to have monthly, you're going to have quarterly. And for those of you, you probably know that the most important ones are the third Fridays of any single month, and on the quarterly expiry. So I strongly advise you to check on the cboe.com website. It's for free, it's even better, and checking, when are those options expiring. First, because you know that during those days, the activity will be a bit different, the volume could be different. And as well, this is important for you to, if you put position, to know what are the different expiries, and if those expiries are hand in hand coming with your catalyst. Okay, so if you put a position in the next 3 months, or if you took, let's say, a March expiry position, make sure, obviously, that you have a catalyst going into the next 3 months, and that your catalyst is not coming into May or June. Okay, so find it helpful. What about now we jump into the price action? If I manage to play with this one. Okay, still okay? You can still see my screens? I hope so. Otherwise, people, you are all gone. So as always, I'll start with the VIX. I said it to you before. That is really, for me, feeling the price action, understanding what is the volatility telling me, and what is the market pricing for the implied volatility. So here, this is the chart. If you take a long-term chart, why I put the 19%, because the 19% is the average VIX since this creation in 1991 or 1992. Okay, but what you can see as well, that many asset classes are all-time high or coming back to level that pre-crisis, and the implied volatility is still pretty high. Okay, it's still pretty high versus history, and that tells you about either the appetite for options, or too much hedging, or mispricing, or one way or another, but volatility is very high. So there is another website that I like, which is called VIXCentral.com. I think it's pretty helpful because you can see what are the future contracts of the VIX and see what is the volatility pricing and the different events. So that is helpful, especially to see when is the market pricing different volatilities based on different expectations. And I would like to look at the S&P futures. So S&P futures is doing fine. So when I say S&P futures, why I take the S&P futures is the S&P, but when you do have like enough capital, you don't do that much SPY. You do mainly the S&P futures because you can be trading 24/7 except weekend. So the trend has been so far, we have been trading. So let me try to do it closer to that. So we have been trading in this channel. So we had the first move after the election, the hoo-ha move, which actually closed the sell-off that we had in the fear of the election. Then we have been rallying nicely but surely. There has been some noise in between, but actually what is interesting is the realized volatility is much lower than the implied volatility. So again, VIX versus realized volatility, something that I strongly advise you to be looking at. But despite all the noise, if you look at the day like yesterday, yes, there was a sell-off of 1% from the top, which is not the end of the world. So we went from 37.80 to 37.40, 40 points, but we are still in this trend so far, so good. If we look now at the NASDAQ, and here I like to be looking at the long-term chart sometimes to give you a picture. So I look at the weekly, and this is a logarithmic chart. If you look at long-term charts, you need to be looking at logarithmic. So we have been breaking higher this trend, sorry, that's we had since 2009. So we are going higher and higher. You decide if that's too much or not, but that's what the market is pricing at the moment. The most important chart these days is this one, which is the Russell 2000. So the Russell 2000, if you look at the chart over 20 years, is now catching up the S&P. So even if it's overperforming the S&P these days, over 20 years, this is not the case. What is interesting is we are up 20% since we broke, and we look at that breakout. I think it was two months ago, roughly. And since then, the Russell has been on the tier. Yesterday, we were up 5% at one stage. So there is rotation into Russell 2000, into small and mid caps, going into more US companies. That has been the ongoing flow. What I find interesting as a chart is the NASDAQ versus the Russell. And so let's do a daily. Again, we are here actually reverting to the mean, but it took in between a larger move. You can see as well, as we mentioned before, that most of the markets in terms of flows, in terms of trend, topped at the start of September 2020. And since then, we have been reverting. We are still reverting and doing this reversion. SOX, which is really an important, so for those of you who don't know what is the SOX, is the Philadelphia Semiconductor Index. That has been a big market leader, and this one is still leading and still pushing higher. And that is quite a tell that the risk on is on. That is helping, obviously, by sectors like solar, like TAN, that is putting new money into that sector. For Europe, I'm not going to be doing too much. DAX is making all-time high. Eurostoxx is not that helpful, so I should be putting the stock 600. Looking at the currencies, euro dollar, again, I mentioned that many times when euro dollar was at 117, 118. I warned you that the way was for the euro to get stronger despite all the noise. The chart, if you do the same chart, you can see that this consolidation is broken. If you think now about the fundamentals, I have to be honest, around 123, and I said to you just before Christmas that now I'm a bit struggling because the carry the carry is getting stronger for the dollar, but there is again Fed fooling the market with a lot of papers. There is too much noise around election, Trump administration, and that is not helping. But the dollar overall has been weakening. You can go across any currency. Dollar has been so that's not the one, so that's not really helpful. If I put this one, where is my Aussie Turkish, even it's the Turkish lira. So yes, that is the chart I wanted to show you. Important level on the Turkish lira. So for those of you who have put a position for quite a long time, the 730 is a big level. On the sterling dollar, I think the way is probably still up, and I'll not be surprised to go to the 140. DXY, the level is getting closer. So do we have, I mean, at least for an intermediate low, which is 1 to 2% from here. Bitcoin, you know the Bitcoin. Again, I've been saying it since 12,500. I'm not a big fan of Bitcoin in terms of securizing my capital. Still, people try to explain to me. That doesn't mean that I go against it or it should go higher. In reality, this is the size at the moment of the Tesla. Well done to people that are long. That's all I can say. I'm not long, but that's you're gonna have many missed opportunities. Yields, what about we go into bonds? So US 10 years, 105, 106. So if we go back to the pre-season or the pre-sell-off, sorry, we could be going into the 156, 160. More importantly, looking at the 10 versus the 2. So there is a huge steepening of the yield curve. Huge, I mean, maybe my English is a bit poor, so I need to use huge, but there has been clearly a steepening of the yield curve, and that has been helping some sectors. So if you look at banks, yesterday they were on fire. The KBE, the banks, both the big banks and the small banks in the US were pretty strong, because again, for banks, inflation and steepening of the yield curve is really helpful. Why? Because they're more short-term and they lend to you long-term. So if there is a wider spread, they're going to be making money. And that tells you as well that there might be inflation coming into the system. So that's something I'm going to be covering next week. We are getting closer to the expectation of 2% inflation, which is the core PCE for the Fed. And that's the mandate of the Fed. If we know that the Fed is going to be running the economy a bit hotter than expected, so probably we might go into the 3%, but that is why bonds are selling off. Plus, there is a lot of paper that is coming out. So that is the crowding out effect, which is when you put too much paper into the market, you have two risks that yields can go high very quickly. And the second risk is because the Fed, because the Treasury is putting that much paper into the market doesn't have enough money to digest the other emissions. So if we carry on with the bonds, high yield doing this play, which is going up and up and up. Now looking at the ETF and the sectors, let's spend a bit more time. So this session, this webinar, I would like to talk a bit more about this because this is the start of the year to give you a bit more color. So emerging market, you know now that it's roughly 50-60% China. It has been on a tear. But if you look at the Chinese PMI came out at 53 something, it's still very strong, but it's less stronger than it was in November. So is it a peak? And if that's the case, emerging EEM is mainly China. A big chunk is China. So be careful. Another chart that I would like for you to see is the, so this one is the stock 600 for European banks. So let me give you a weekly chart. So as always, my conviction is you don't want to be spending and too much into technical analysis and being a professional. I'd like to be very basic in my technical analysis, support, resistance. So what we used to have as a support, which broke like big time in March last year, is now resistance. So the 115, 116 level, which is 2-3%, is a very important level. European banks, like US banks, did very well yesterday. British banks were up big time. And again, that might be sometimes hard on one hand to watch TV, to hear the headlines of, UK stopping, Europe struggling, US struggling a bit more than before, and markets making new time high. Again, my conviction is really respect the price action, even if some people are making fun of it. Those are the people that have been selling papers for years and years. So FSTB1, look at those ones. You can have the same as the S&P 500 for all the sectors of the stock 600. Commodities, CL2, not CL1, because again, CL1 is distorted by the sell-off. We are getting close to the 53, 55 level before the sell-off. Why? Because the OPEC is following the plan. And cutting as well for Saudi Arabia. So Saudi Arabia cut production by 1 million, which is 1 million makes 1% in a normal world of 100 million barrels. But as long as they stick to the plan, it's gonna be fine. Why? Because you still have a lot of inventories of last year based on low demand. So to swallow this demand, you really need those producers to respect the plan of not putting too much supply coming into the market. So our economies are restarting, but they are still not as active as they used to be. Another one that I like is chart. I've been telling you for the last 20-30% at least, which is the copper. Copper is moving nicely. This is, again, this is a logarithmic chart. So that tells you about the strength of this move. China is doing fine, is still doing fine. The world is restarting. That is something that I'll be covering next week on 2021, looking at copper, looking at nickel, and because I think there are some good trades to do here. So that's for the commodities. Sorry, I forgot the gold. I know that some of you are looking at gold. So gold trading sideways, but a bit of a move. As we discussed before the election, actually in 2016, there was a 10% sell-off for the gold. Exactly the same thing happened. Now we recovered from this level. There is a tell between, economies restarting and the flight to safety, and new competition coming with Bitcoin. So that is the goal so far. A lot of noise, but if you look at the chart for the last 3 to 6 months, this is consolidating. What about quickly, we go into some of the sectors I would like to. So SPY-G versus SPY-V, that is the S&P growth versus the S&P value. And as you can see, again, since September, the top of September, value has been making a bit of a comeback. As always, you need to put everything into perspective. And if you do the same chart on a weekly, you can see, as long as I manage to do something with this chart, that there has been a big move. And this reversion to the mean is probably much, much lower. So we got to start, when yields are going up, by definition, you have money going into value. And this is what is happening. That is still ongoing. And try, like we've done for the sectors, try to do the same with the ETF from some what we call the factoring, and where people are putting money. Some charts, so when we look at the sectors, there are two ways of looking at it. They are on the standalone basis, which is absolute basis, and versus the benchmark, which is the S&P. So you do versus the SPY. So if you go into TradingView, you put your XLF here, which is for the financials in the US, and you can do the XLF versus the SPY. And here you can see, if you do on the daily chart, that actually yesterday was a big move for the sector versus the S&P. So the sector, which has been a laggard because of the COVID situation, has been making a big move yesterday on the 2 and the 10 years, on the 10 years. And I like to be looking at those charts every week, trying to find out what is trending well and not well. So if you look at XLRE, which stands for a real estate, XLU for utilities versus the SPY, they have been struggling. Why? Again, because yields are going up, and since then those two sectors have been struggling. Another chart that I find interesting, which is XLV. So if we look at pharma, this is a strong support. I've been bouncing nicely so far. We'll see what it's going to do in the future. Other charts that I like, something that I mentioned last summer, going into infrastructure, IFRA. So in July last year, we did together webinars, and we say, anyhow, what's going to happen, Trump or no Trump, we're going to have a lot of infrastructure coming. And yesterday was even more confirmation. So there are some trends that are still carrying on. You get the TAN, which is the ETF solar. That one is more than a tier. I don't know what to think anymore about this one. Those are so we went from the top, which is the indexes, we went into the sectors. Now we try to scroll down into the industries, and finally we finished on the stock level. On the stock level, BABA, which is making the headlines, that is a chart that we checked, I think, before in November, when you had the breakdown. Since then, guess what? You get the news about what's his name, Mr. Alibaba CEO, Jack Ma, and the news. Very often, you're going to be able, with looking at those chart, the price action, to get some good understanding. BABA, FCX, which is Freeport. I mentioned that when it was in the 17th, 18th. It's been on a tier. One of my mentees is hopefully put the position, hopefully a week ago, for a good trade. GE as well. So those are all the cyclicals that are doing pretty well. Again, different strategies, different time frames. This is something that I do. I like to be doing. What I like for you to do is looking at this chart and putting some alerts on your different platform that you'll be using. Uranium, I got a question from Andrew. Yes, I look at uranium. If you look at, if you watch my 2020 outlook, I discussed uranium quite a lot, and I was too early. I said that uranium will probably do well. It is clear that if we go clean energy, if we go with electric vehicles, we need to have more uranium. And there is a scarcity, at least there is an imbalance between supply and demand. And actually, there are not that many ways to play those uranium. You're gonna have some big companies, but not that much. So I'm always looking at those first, at these commodities. Then for me, what is more interesting is trying to find the second derivative, because if you look at the commodity, that's not an easy game to play, but everyone is talking about it. If you spend a bit more time, if you do your homework, then you're going to be able to find the names that are going to be benefiting from the move of a commodity. So that's what I call, or anyone call, the second derivative. And for me, historically, this is where I made most money, which is when I've done my homework and when I've been playing the second derivative. So chart, let's go now back into my PDF. Okay, so PDF now. Central banks, because we need every single call, sorry for that, but to be discussing the central banks, both the ECB, the Fed, and the Bank of Japan, and some others. So here, this is the Fed, and here we are looking at the euro-dollar futures. do some Wikipedia, Eurodollar futures if you don't know what it is, or even better, subscribe to the 4x4 video series. So more or less, this is telling you what are the Fed expectations in the next few months and years. And you need to do 100 minus this number. If I do this number here, that would be better, or up. If I do that, okay. So that tells you what is the Fed. So as you can see, until March 2023, we expect almost something flattish. So that gives you another 2 years where market participants are expecting nothing from the Fed. So on one hand, as we will see, we're going to have some inflation coming. And on the other hand, so far, the Fed, we expect not much from the Fed. And as well, the 10 years is going higher. So the Fed is controlling the short end of the yield curve, but is struggling to control the long end of the yield curve. So that's going to be interesting to see what Mr. Powell is going to say in 2 weeks' time regarding the long end of the yield curve. Because even if it's good for banks, that means as well that the cost of money, the cost of financing is going higher. Next one is the balance sheet. Look at this chart from the ECB, look at this chart from the Fed, and it's not like it's reverting to the mean. It's not, it carries on. So remember what happened in March. We got all these talks first about central banks coming. The Fed came and had a small program. The market said, no, it's not enough. And then they came with a massive program and the market went on the tear. So as long as, you have a lot of liquidity from the central banks, now you get the Democrats that are in full power. That means you're going to have a fiscal stimulus. For the Democrats, if you remember, what I've been saying is the first move is, I think it's going to be a hoo-ha move because it's great. We're going to have fiscal stimulus. We're going to have more money. We're going to have, printing, and that's going to be the next 2, 3, 4 years. In the long run, I think what works for different countries is when you get a balance between Democrats and Republicans, and it's even more true for the US. So in the long run, that might lead to another push, a creation of like a massive bubble. I don't think this is necessarily good. And I'm not taking a stand or making a declaration that I am Republican or Democrat. This is not the way I do things, just that I think the risk is there for having imbalances based on the politics. What about we do a bit of macro and not only price action? So world PMIs, great leading indicator. So this is the JP Morgan. So for the month of December, we are at 53.8. So we are making a small top. What is interesting is there is clearly a supply chain pressures growing. Why? Because our economies can't be restarting the way they want because of COVID. So that creates, how do you say that in English? That creates frictions along the value chain and the production, and that is clearly an issue. So if you listen to what Fed Chairman Powell said in December, we will have for the next few months some inflation coming into the system. Okay, and here, so let's talk quickly about the world PMI. So the world PMI, the picture is more or less the same. The countries that have been doing well in the past are still doing well, but I want more importantly to go into this one, which is the US ISM manufacturing. And so both the index headline and the new orders are doing fine. The issue might be and is with the prices. So prices are kicking higher. And again, Fed has been saying we have in the following months some friction in the system that will lead into some inflation. Now, the expectation from the market participants are 2%. So normally on 2%, you should not have the Fed fund rates at 0 and 25 bips, between 0 and 25 bips. You should quickly have a move. We know that the Fed wants to be running the game hotter than usual. So it might take a bit more time for the Fed to do something, and that could be as well a short-term jump in the inflation. But what is not, well, it's helping on one hand, but you're going to see even more inflation. Why? Because all the commodities are on the tier. Okay, so if you get WTI at 51 something, that means that the month on month is going to be looking ugly. So that is for the ISM manufacturing. Overall, still pretty, I mean, more than still pretty good, very good ISM manufacturing. Only caveat is the prices. Because if you have prices and if you look at the comments that are coming from the different sectors, you can read between the lines that there is inflation, that there is some tension coming. So out of the sectors that are printing nicely, apparel. All my mentees are coming each time doing the first session, it's coming with apparel. Machinery is doing fine. Petroleum, by definition, since we had the recovery and the move from 30 to 50, guess what? Petroleum now is looking pretty well. I think what you need to be doing for this XLE sector is looking at how those different majors are hedged going into 2021. And then for the sectors, for the services, it's going to be taking a bit more time for the services to restart. Why? Because new projects are not going to come online pretty quickly. You'll have to wait probably another 6 months for CapEx to come. And then between the moment you put the CapEx and they go into stream, you are talking at best half of 2022. On the other hand, the sector that was quite negative is non-metallic mineral products. There are some names if you do, and here don't blame me if I don't give you a name and where to buy and where to sell. There are some interesting names. The difficulty as always with the ISM, don't only do the ISM and saying, oh, okay, it's ranking nicely. Think about, put the ISM in what you see in the world. So ISM, non-metallic product, but in the meantime, the Democrats have full power. That means it's going to help infrastructure, that is going to be helping the whole sector to rebuild. So again, be careful on just taking the ISM as the magic formula. Quickly going through my education 4x4 video series. Launched the product in October 2019. Last month we had many newcomers, so welcome to all of you. It's based on my experience as an educator and as a portfolio manager for the last 20 years. So you're going to have different ways of doing your filtering, top-down, bottom-up, special situation and active trading. You're going to have 40 plus videos. That makes a bit more than 30 hours of footage, 50 plus Excel spreadsheet. Why? Because I want you to be able to build your infrastructure. I'm not asking money for you to subscribe to my data. And so if you want testimonials, if you want information, it's on the website. Mentoring program. So mentoring program had many people coming recently, which is a good thing. As I told you before, maybe you don't know, maybe you don't care, is my time is going to be constrained now because I'm taking a book again. So I'm going to have a bit less time, and I want you to have as much as possible as a good service for the mentoring. So I'm not going to have as many mentees as before, but the idea is exactly the same as the 4x4. It's building your infrastructure, either if you want to be managing your own money or if you want to have access to the industry. Mentoring works very well, but I have to say this is a strong commitment from you guys because you need to put the hours. So if you think that it's going to be, how do you say in English, an easy run to the park, actually there's a lot of commitment, and people are always surprised and always need to push more than what they thought. But it works well. That's a huge commitment. I like it. I enjoy doing it. And if I want to do it in a good way, I need to limit the places of the mentoring. Finally, next week I do, sorry if I bother you with all of this, but I do next week an ID generation webinar, which is going to be the same as what I did in 2020. The difference is now this year I decided to do it through the paid-all. Why? Because it's going to be a 90 minutes webinar. It's going to be pretty intense. And what we're going to be covering, as always, is what happened in 2020 and looking for ideas across asset classes. Very similar to what we've done today, but more advanced, much more professional. So you can be either, if you are new to the market and you want to have ideas and understanding how to do your process, or if you are an individual and you've been trading for quite a long time, and as well you want to generate ideas. There's a question from Jem. Is it necessary to take the 4x4 course before getting on the mentoring? My conviction now is, I'm 100% convinced now, it is in terms of risk reward, you need to be doing the 4x4 before doing the mentoring. Some people are coming to me and say, look, yeah, Greg, I've been trading for quite a lot, or I've been go through other education. The reality, if you look at the comments, at the testimonials, people are clearly telling me that the 4x4 is a more advanced product. Okay, it is much better, and I know that if you spend the money on mentoring before that, you need not only to be spending the money on the 4x4, but more importantly, spending the time and building the infrastructure. To give you an indication, I was 9 months ago talking to someone, and I'm still talking to him about, that was in March, about doing the webinar, doing the mentoring, I think it was in September, 3 or 6 months later. And for the last 9 months, he has been building an infrastructure, and we're probably going to be doing the mentoring in May of this year, June. And I could have told him, you know, oh, what about you do the mentoring in September, because I do have some free time. My view is the 4x4 is, I mean, is a good product. It's going to help you, that is something that with the help of the mentoring, you're going to go hopefully even higher. My conviction and why I build, when I build the 4x4 is I wanted to put everything into the 4x4. So it's not like you're going to be missing some data on purpose or some ideas just for you to come to the mentoring. If you come to the mentoring, that's good. That means we're going to have a relation for 3 or 6 months, and we're going to go, and I'm going to try to help you and push you. But my conviction as well is the 4x4 video series is good enough for you to learn what is needed for having a good investment process. Okay, in terms of webinars, as I told you before, there is this one next week. I'm not sure I'm going to be doing as many as I used to do because of time constraint. I still enjoy doing it. I need to find the format, because if it's too long, you're getting bored. I hope you still enjoy. I need to have back and forth conversation. So that means if you think that there are stuff that could be improving, or there are products, ideas, strategies that you'll be struggling and you would like to have, or me to discuss, maybe instead of doing one every 2 weeks, I can do a bit less, but something that is more, let's say, directed to your needs. So again, Happy New Year to all of you. I hope 2021 is going to be a good year for all of you. I hope there's going to be a lot of volatility, a lot of things happening, that your life is going to be good. Thank you for your support. Thank you for following me. If you like what I do, please forward, say, you know, I like it, do some comments, because that helps for the product. And that helps as well for providing those services. Thank you very much. Maybe see you next week. Otherwise, see you later. Bye-bye, everyone.